Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Karen McCormick of Beringia to talk about the Proven VCTs. Hello Karen, welcome back to the studio. So we're here to talk about the Proven VCTs. What are they, what makes them different, and why should investors consider them?
Sure, thank you. The Proven VCTs invest in relatively early stage companies with high investment prospects, but with proven commercial traction, great management teams, a defensible moat, and great exit prospects. The Proven VCTs target a 5% annual dividend, and one of the things that makes us interesting and unique is our combined US and UK presence. Beringia, the manager of the Proven VCTs, has had a US and UK presence for over 30 years, and we can help businesses commercialize into the US, which both helps us win new deals with entrepreneurs and then increase the exit prospects.
So could you give us a little bit more detail on who Beringia are and your role there?
Sure. As mentioned, so Beringia has a 30-year history of investing in early stage companies and also having a transatlantic presence. My role as Chief Investment Officer involves working with the VCT boards and our investment committee to set the annual strategy for the VCTs, also to work with sourcing and finding businesses, putting them through due diligence, monitoring the portfolio, and seeing those through to exit.
And what types of companies are the VCTs looking to invest in?
Sure, the VCTs are looking to invest in, as I mentioned, relatively early stage businesses, but generally they will have commercial traction. So for us, that means anywhere between roughly £1 million and £15 million of revenue at the time of investment. While we're a generalist investor, we do move with the times, and the way we think about different sectors or technologies to invest in is on kind of an immediate term horizon, which is within the next 12 to 24 months, what might we invest in? Within the next 3 years, what's on the horizon? And within the next 5, what do we need to be aware of? One of the areas that's obviously top of mind right now is artificial intelligence, and so it's an area we've been looking at for some time. And we actually invested early on in a legal tech AI business called Astemos, which we sold last year. In terms of AI, we aren't specifically looking to invest in, for example, large language models, which require huge amounts of capital in order to get to success, but looking rather at how our portfolio companies can harness AI. So sectorally, we still invest generally in multiple sectors. So about a third of the portfolio is SaaS and business software. About a third is in consumer and consumer related. And then we have a number of other areas like healthcare and business services. And we would look at how AI, for example, can apply across those rather than investing specifically in one technology.
And so how do you source these investments? Is there a particular competitive advantage for Beringia? You mentioned the transatlantic element there. Yeah,
I think we do have a number of competitive advantages. The US angle is a significant one. Entrepreneurs want to go there and they recognize that there's bigger exit prospects if they can make it there. So it does help us win deals. It also helps us realize better exits, both for the portfolio and the entrepreneurs. But we also have unique sets of tools that we use in-house to try and find proprietary deals. I think that's actually more relevant right now because what we're finding is a lot of the great businesses that we're investing in at the moment aren't actively coming to market, and certainly less so through intermediaries to some extent, because they believe that the markets are effectively shut to them. So we're doing a lot more outbound and proprietary deal finding at the moment.
And would that be where maybe an entrepreneur has raised money in the past from Beringia and they're raising again or referring someone on?
It could well be. So in addition to, we harness a number of technology tools to help us find these businesses, but many of them, you're right, come through our network. And that could be former entrepreneurs of the portfolio, non-execs that we work with regularly, angels and angel groups that we work with, so through our own network.
So can you give us some examples of companies you've backed recently in the VCTs?
Sure, yeah. We've had a relatively busy year, actually. So a couple of the businesses that we've recently invested in, one would include a business like Dash Water, which is a seltzer water company. Hopefully many of you have had the pleasure of experiencing Dash Water. One of the things that helped us there was our experience in the US, where the seltzer water market is a highly developed market. So we have history that we can reference in terms of looking for the amount of investment required, the expected growth rates, things like that. Business has done very well, and part of the attraction of that was the management themselves, who came from the sector and were able to attract a great board of directors that also had deep sectoral expertise. I might also mention Gorilla, which is a very different business in the energy pricing and forecasting sector. One of the things that really attracted us to that business was the founding team and the founder himself, who is a deep data expert, and his history comes from both dealing with data and this sector in particular. And so their proprietary data sets that helped them build and inform the models to make better decision-making and forecasting for energy businesses has led them to really converting a lot of blue chip clients.
And if we look at some of the more established holdings in the portfolio, any examples there? Any highlights?
Sure. We do have some relative mature businesses, and some of your investors and ours might be familiar with companies like MPB, which is a pre-owned camera equipment company. We have a history of investing in circular economy, so pre-owned high-value items. MPB continues to do extremely well, is at this point a relatively global business. And very mature, and the growth rate continues to be extremely strong despite the maturity of the business. I could also mention Lupa Foods, which is a little bit of an unusual one for us, but it's they specialize in high-end, basically Italian specialty foods, so things like sun-dried tomatoes, olive oils, pastas, and they have broad distribution across a number of channels, including major grocery stores, wholesale food supply to restaurants, to meal kit companies, and also their own consumer-facing brand. And one of the things that has served them well is the variety of the distribution channels means that if one channel is struggling, another channel is up. And they've continued to perform very well over really a long period of time.
And Lucky Saints, which seems to be everywhere now.
Lucky Saint, which is a non-alcoholic beer company, is doing phenomenally well. And for us, again, the management team were phenomenal, but the product itself was just absolutely outstanding.
Very good. And so when you back some of these teams, how involved do you get with the business? Is it a case that you just back a great team and let them get on with it? Or are there things that Beringer can do to help? Yeah,
of course. I mean, a lot of the times our value add is knowing when to get out of the way, but we do look to add value to the businesses. And some of those, as I mentioned, the US, again, is definitely an area that people are very interested in. And we can help with everything from early planning, so just thinking about it well ahead of when we're getting there and helping the businesses understand how the costs are going to be different, what the tax regimes look like, where to establish yourself, but also things like what lawyers, accountants, bankers should we be using, provide desks on the ground, give them a peer-to-peer network in the US. Yeah. In addition, we have a number of things that I would say are our regular value adds, so things like our portfolio hub, which is a repository of information about things like the FAQs that we get. What are good headhunters for this particular arena, lawyers for this type of activity. And we also run a Scale Up Academy, which is a monthly session of events that focus on anything that could be facing CEOs and entrepreneurs in their journey, things like building a great go-to-market function for a SaaS business, or shifting from accounting to strategic finance, those types of things. And then lastly, I would say one of the things that I think also makes us different is that we target ourselves internally on revenue and partnership value add. So we regularly sit down as a team and go through our networks and lists of clients that our portfolio would love to get in touch with and target ourselves on getting them those introductions.
Oh, very good. That's very interesting. And changing topic completely, exits. We've been hearing it's been a very quiet couple of years for exits. How has it been for your portfolio? Any recent exits you can talk about?
Yeah, it's a good question. We have actually, and you're right, the market has been tougher, but I think the construction of our portfolio lends itself to exiting in multiple types of environments. So I go back to the idea that we aren't investing in either pre-revenue or highly cash-consuming businesses. So at any given time, close to half of our portfolio will be either in profit or break even, which makes them very saleable in all types of environments. And in the last couple of years, so over the course of 2023 and 2024, we've actually had 3 good exits. Astamos, I mentioned before, which was the legal tech artificial intelligence business. Firefly, which was an educational learning business. And then Monica Vinader, which many of you might be familiar with. We received a fantastic 13 times money last year when we exited that business fully.
Good, very good. That's very interesting. And if we turn to risks now, what are the risks with investing in your VCT? How risky is this?
Yeah, of course. I mean, it's early stage companies, so of course there is risk. I would go back to the idea that a lot of our businesses at the time that we invest, we believe they will be saleable entities. So our real loss ratio or write-off ratio for companies is quite low. It will be maybe one company every few years. But of course, there are risks to investing. And some of the ways that we help try to mitigate that, helping entrepreneurs identify relatively early when we need to react to market changes, whether that's the external environment or that's our own revenue, just making sure that we're acting ahead of the curve rather than reacting too late. One of the other considerations for us as investment managers is knowing when to effectively say we're not just going to keep funding a business. So making sure that if we don't see the upside or if the business needs to restructure in order to be able to move forward, making sure that we aren't continuing to fund a business plan that won't work.
And it's been a pretty tough environment recently, so you may be having more of those conversations, perhaps. How are you finding the current environment?
It's a good question. I mean, we have been around for quite a few decades, and so this is, from my own perspective, my third economic cycle, and it does feel a bit different in that there hasn't been a clear reset the same way that there was in, say, 2001 or 2008. So it's a difficult environment in many ways just because of the unpredictability. But we still find a lot of our businesses are doing incredibly well. And I know I keep mentioning the US, but it really has been a hedge for us over the last couple of years, where we have seen some softening in the UK market. There's remained buoyancy in the US market. So our US sales across the portfolio have in some cases made up for the softening of the UK market. But I would say recently, especially in the last few quarters, we have seen, dare I say, a comeback in a lot of the commercials in Europe as well.
Very interesting. So where are you seeing the best opportunities? Any particular sectors that spring to mind?
It's an interesting question. So in terms of opportunities, I mean, the market is rife with AI opportunities. Some of them are legitimate. Some of them are probably being packaged as AI. As I mentioned before, we are probably not the right investors to go deep into AI technology, but rather harness it for our portfolio. And so the opportunities for us that we're finding are really more about finding the proprietary deals. So having to look harder to find the businesses that aren't necessarily actively coming to market because they don't think the markets are available to them. And I would say the challenge with that is it does take longer. We have to go out and find the businesses, and they aren't necessarily well packaged for a raise. So they don't necessarily have a data room set up and forward models built. And so we have to work with the teams to build the investment case. But those businesses tend to be really solid businesses in terms of the capital efficiency because they've been running off of their own steam. They've proven that they can build a product in a market that people want without overspending to get there. And so we're finding really solid businesses that way.
Very good. So to sum up then, Karen, for those that want to invest in a VCT this year, why should they choose the Proven VCTs?
I think the Proven VCTs are a great choice because of our long track record of delivering returns. The 5% dividend that we've been pretty consistent with and returned greater dividends when we've had great exits. And then our US presence really makes it a differentiating factor.
Karen McCormick of Beringia, thank you very much.
Thank you.
If you are watching on YouTube, please press like and subscribe to the channel for more.